Alright, here's where we left off on the last video. We just finished our statement of cash flows and we found ourselves in a $165 hole. And we said that, well, that's either because we made a mistake in our accounting or we've run our business into the ground. And what we need to do is finish the process to try to figure it out. So let's roll over here to the ending balance sheet and let's fill it out. So our cash is going to be equal to the ending cash from our statement of cash flow. So we'll just type an equal sign in the cash box and then click on that negative 165 and press enter. All right, our inventory, type an equal sign, and the inventory can be found on our income statement. Our ending inventory is 125. We'll click on that and off we go. Our equipment is going to be equal to the equipment we had before, our $400 worth of equipment off the previous balance sheet, minus our depreciation of $200. So let's go there. And now we can total everything up. Our total current assets is equal to the sum of these other items. So we'll sum those up using the auto sum function and we get a negative number. Not looking good. Let's hope there's a mistake and we're not running the business into the ground. Equipment, the same thing, equals sum, open parentheses, and click on the 200 and close the parentheses. And hey, we are off and running. We'll total the assets up equals sum, open parentheses, click on the negative 40, drag down to the 200, release, close the parenthesis, and hit enter. Hey, we're doing good. Now, liabilities. We had the revolving credit that was $400 before minus the $200 over here in the repayment of debt off of the statement of cash flows. And hit enter. So our total current liabilities is going to be equal to the sum of all of our current liabilities, which is just this one number. Our equity comes from the statement of owner's equity. It's equal to the ending equity of $235 over here in cell 09. Highlight the cell, we get a cell reference, we hit enter, and we've got a number. So we're going to add up all that. Equals sum, open parentheses, highlight the 200, highlight all the way down to the 235, let go of the mouse, close the parentheses, hit enter, and we get 435. And the first thing we notice is that our balance sheet does not balance. 160 and 435 are not the same numbers. That means we've made a mistake somewhere. We may have made multiple mistakes. So what we need to do is go through and kind of hunt down our mistakes. Now, I'm just going to be honest with you. I put a mistake in there on purpose because I wanted to illustrate to you that the balance sheet balances because you did everything right. Does that make sense? A lot of times people who are new to this will total up assets and total up liabilities and then subtract and have equity and then put the equity on the balance sheet and kind of force the balance sheet to balance. That's not how balance sheets actually work. All the information comes from somewhere else, and you can use the balance sheet as a snapshot of your business and as a way of seeing if your accounting procedures are correct. There's an old school thing called double entry accounting, and the whole point behind it is you have an entry on the left and an entry on the right, and these things total up at the bottom, and the balance sheet is partially based on that concept of double entry accounting and partially based on the fundamental accounting identity that assets equal liabilities plus equity. So let's hunt down some mistakes. Well, I know one of the mistakes because I remember very deliberately making this one. And that's in the cash operating expenses, right? When we calculated the cash operating expenses, we just took the total operating expenses. But total operating expenses are not cash operating expenses. One of these expenses is depreciation, right here. Depreciation is unique in that it is a non-cash expense, meaning you don't have to spend any money to spend money on depreciation. So what we're going to do is we're going to go into our cash operating expenses. We're going to double click to edit the cell, and we're going to subtract from it our depreciation of $200. And we hit enter. And hey, that's good news. We now have positive ending cash. Let's scroll over and see if our balance sheet balanced. Uh-oh, the balance sheet still didn't balance, which means we've got some mistake somewhere else in this document. Let's see if we can figure out where it is. So, let's take a look at this cash received from operations. And let's ask, maybe we calculated that wrong. maybe we should make that equal to our sales minus our purchases. Let's hit enter. Now we have even more ending cash of 110, and we scroll over and we find that our balance sheet now balances just fine. So what happened here was we entered in cash received from operations incorrectly. The cash received from operations is supposed to be your sales minus your purchases. The thing to remember is the gross margin is equal to your sales minus the cost of goods sold. And what you've got to remember about cost of goods sold is some of that cost of goods sold was based on cash purchases of inventory made at some other point. So what you have to do there in order to understand the cash that's flowing during the year 1990 is you've got to focus on sales versus purchases. And that's kind of important because you've got to think about things in terms of where the cash is flowing from and where the cash is flowing to. And the beginning inventory doesn't have any cash flow associated with it during this calendar year. And now we have a full system with balance sheets that balance, an income statement that totals up, and it's a positive number at the end. We have equity. We have all this great stuff going on. So let's roll over here and take a look at the beginning and ending balance sheet. And I have a question for you. Is the business better off than it was before? And that's what I kind of want to start drawing our eye to. So if we take a look at our assets, previously we had $800 worth of assets. Now we have $435 worth of assets. One might argue that that is a bad thing because having assets is good. But at the same time, previously we had $400 in liability. Now we have $200 in liability. Well, less liability is a good thing. And then our equity, we used to have $400, now we have $235. Well, less equity is a bad thing. And what we're going to be doing next in this process is we're going to be coming up with some ratios that we can use to compare these numbers to try to establish whether or not we're better off at the end of 1990 than we are at the end of 1989. So we're going to start working on some tests of liquidity and solvency and some other finance ratios that we can use in order to lay all this out and understand if the business actually got better over time. So thank you so much for watching. Hope you found that educational and useful. Please hit that subscribe button if you'd like to. A lot of you are watching this because maybe it's a part of a class and your professor directed you to this so that you could do some activity in a class, but there's going to be a day when you're going to want to go back and see this information. It's going to be handy to just to be able to check out your YouTube subscriptions and go and find the old video, and that way you can go back and relearn material and review material all that you want. Thank you so much for watching, and this is Agribusiness with Dr. G, and I'm signing out.